Welcome to Green Wealth Management Group's Mid-Year Market Update 2026. My name is Drew Heatley. I am a financial advisor and partner at Green Wealth Management Group, and today we're going to cover the market and the economy at the mid-year point and what we can expect moving forward for the balance of the year. Without further ado, let's get started with the economy. As you can see at the end of the second quarter, all the major signposts for economic data are showing green flashing lights with one exception, and that is job sentiment. Job sentiment and other labor market characteristics have actually kind of notably been hard to pinpoint and hard to read through since the pandemic, as a lot of those data points have had a lot of time to normalize since then, and it's been difficult to get a read there. But overall, the green lights look good, and it has shown strength over the last couple quarters, improving in some notable areas as well. All things considered, a strong, resilient, and growing economy. Now, where's a lot of that growth actually coming from? Well, despite a declining overall GDP rate the last 3 years, we've had 3 strong years of consumer-driven consumption that have kept the GDP numbers strong and moving in the right direction. Even in the first quarter of 2025, the economy rebounded from the tariff shock and never really looked back the remainder of that year. Strong consumer driving economic output. Now, unfortunately, that spending is not evenly distributed across every American. It's clumpy and kind of being lumped together at the top, with about 40% of the income earners contributing 61% of all the spending. So they're kind of out earning their proportion. And a lot of that has to do with the wealth effect that's being felt at the tippy top, with the top 20% of all income earners seeing an increase in their net worth of $48 trillion dating back to 2020. That's a huge increase. And if you own a home or real estate, if you own stocks, and if you have cash balances, you will have had a huge appreciation in your net worth during that time frame. And like a lot of Americans out there, if you don't have those things, you will have stayed relatively stagnant during this inflationary period. That's what they're calling the K-shaped economy. And unfortunately, the K-shaped economy is another term for the haves and the have-nots. Now, if you look at the average household balance in total, and you look at a couple key points, I will say 11% of all income going back out to service debt is relatively low. It's not quite at the low point, but it is towards a 45-year low for the average U.S. household. The average balance sheet across America looks pretty strong, but again, that's likely skewed by that top 20%. All in all, I'd say the average household is in good financial shape, although inflation is definitely weighing on them, as it is all Americans. But when you're left with just the cost of living increasing from inflation and none of those asset benefits we talked about before, it can get tough to make ends meet. And let's be very clear, the inflation in front of us that has been around since the pandemic, peaking at 9% in June of 2022, that's still in the system. It has not gone anywhere. We have not had price declines in any way, shape, or form. We're really just talking about prices going up at whatever rate we're talking about in the moment, whether it's strong, moderate, or lower, it's still price increases. Now, fortunately, with the exacerbation to inflation from the war in Iran, we are seeing some relief at the pump over the last couple months. Now, we all know it's very volatile. There's always an agreement on the table or taken off the table day after day after day. But fortunately, the increase in price at the pump has rolled over and hopefully will remain at a relatively low level. And you could view this as a pretty big tailwind for the economy to resume its growth trajectory we talked about before, driven by spending. What we can also consider to be a tailwind comes from tax reform, as listed in the One Big Beautiful Bill Act that mostly is kicked in 2026 In fact, we're estimating about a full percentage point can get contributed to GDP just from tax reform. That's a pretty big safety net to have overall. If we do face a lower GDP from the energy shock or something else macroeconomically, at least we have some tax reform that can keep us moving in the right direction. And that feeling, that benefit will continue for a couple years, albeit dwindling as we go forward. Now, as it relates to the other side of the coin of tax relief, well, the federal government isn't taking in as much tax revenue. So the issue that we find year over year is that we're running pretty high deficits, and the tax reform in the OBA bill will not really help that. And if you total it and put a number on it, we're looking at about a $1.8 trillion deficit. That's 25% of the budget. And we really do need to fill that. And of course, it's being filled with debt. We're issuing new treasuries to fill that gap. And we hit an interesting marker this year when the interest to service our debt crossed $1 trillion for the first time. About 14% of all of our spending is headed towards servicing our existing debt. Meanwhile, we're tacking on another, almost 2 trillion. What's a trillion among friends? Our national debt is now about 40 trillion in total. And if you were to believe the Congressional Budget Office, you can see in the next 10 years, the debt to GDP ratio will climb basically from 100% where it is now to 120% over the next 10 years. So certainly an issue we're going to have to face. Now, one of the detriments to running ultra high deficits is that the interest rate environment becomes more and more punitive to the U.S. If you think about it as the U.S. being the borrower and the rest of the world being the lender is going to require a higher interest rate of the borrower if their credit scores get materially worse or even incrementally worse. And that's what we have seen over the last number of years, is that the U.S. credit score, if you will, has gotten worse. Our debt levels have increased relative to our income. And the same as if you were an individual, the U.S. will be treated the same. The lenders will require more interest, and that's the rest of the world speaking, and they speak through the interest rate environment. And what you're looking at here with the light blue bar is the interest curve for treasuries at the end of 2025, and the dark blue is where we stand at the end of the second quarter of this year. Across every level, the interest rate environment has shifted higher. So we're operating in an absolutely higher interest rate environment than we were 6 months ago, and a lot of that could be pegged certainly to running high deficits. Really an unfortunate circumstance. Now, one of the biggest tailwinds that we can really point to, and this is true of both the economy and the market, is the absolute treasure trove being invested into the ground on AI-related projects, that's artificial intelligence, by the hyperscalers. Now, hyperscaler is a term that's used for these mega cap tech companies that have public clouds as part of their operations. You can see these companies here are listed, 5 of them in total, and just those 5 companies alone in 2025 invested $450 billion of their own cash flow, their own profit, back into AI-related projects. And you could consider a project as being a data center. That's the easiest dots to connect with respect to these projects. And if you think about a data center, you're going to need excavators to dig the holes, a professional services company to design and do the architecture, a power company to connect you to the grid, a gas turbine company to provide backup power. You need the chips and the racks and the flooring and the ceiling and everything that goes into building a data center you're going to need. And at the end of the day, $450 billion from these 5 companies was invested in those kind of things. This year, it's estimated to be $750 billion. 2027, now we're talking 900 billion plus, on our way to 1 trillion. And it's no surprise that I had brought up the federal budget line items a slide or two before, because we're talking about CapEx budgets in line with a federal budget line item like the defense budget, as an example. So this is massive, massive spending, and these billions are getting sprinkled across public and private economy, really boosting GDP and certainly boosting the market. It is by far and away the biggest factor at play right now in a lot of different ways. And you might say, okay, well, after all these years of spending, how could it continue? Well, if you look at past innovative periods of investment, particularly the railroads, which were quite revolutionary, we might have a ways to go. Certainly time will tell, but we're looking at some pretty big numbers relative to GDP, and we're still trailing those past periods. Now, the dark side to this is that the mega cap tech companies, those hyperscalers, if you will, they were about as profitable of companies as existed in history. Stockpiling cash, initiating dividends, buying back their shares, and then they started spending on AI, and it's expected that their free cash flow will trend to zero over the next year or two as they make these investments, which is a pretty hefty bet to make. And at the end of the day, this is screaming from a portfolio management perspective for diversification. And we'll talk a little bit about how one can do that with other parts of the market moving forward. So where do we stand with respect to the markets at halftime? Well, if you look across these major asset classes, stocks obviously have done the best, although they did have drawdowns in the spring during the war in Iran getting kicked off. And if you are an interest rate or inflation sensitive investment like cash or bonds, you're really just treading water at this point in the year. Time will tell for the back half, but that's where we stand for most of the major asset classes at the midpoint, with actually a surprise winner being small cap stocks, which we'll touch on in a minute. So let's get into stocks, and everyone wants to know how the equity markets are doing. Well, first, let's talk a little bit about value. Interestingly enough, and this doesn't happen very often at all, the market has gotten cheaper, more valuable as the year has gone on, despite the increase in the market, in the stock market price. That is, again, a phenomenon that doesn't happen that often. It basically means that earnings are going up at a higher rate than the price is increasing. Very unique and a great fundamental place to be as a stock investor. Now, just to contextualize that a little bit, when you look at where earnings estimates for the full calendar year were last quarter, we were estimating a 17% earnings increase from 25 to 26. Now we are estimating 24% earnings growth. That's a huge, huge increase in earnings estimates. And you can see it across every future year period as well, shifting from already great numbers to even better as the quarters have gone on and we've gotten more information from these public companies. Certainly a great place to be in, again, as a fundamental equity investor. Now, we can see that it's not quite isolated in certain industries, in certain sectors, but it is concentrated to some degree in energy. These are the price returns this year in the energy sector, price return this year in the industrial sector, IT. I mean, you really need those three to build a data center, right? You need energy companies, industrial companies, and tech companies, and sprinkle in some real estate and materials along the way. And that's really been the sectors that have been performing this year, with some laggards notably being financials and healthcare and consumer discretionary. So interesting to note, and it aligns a lot with the theme that we just talked about. Now, what has also changed is the framework of the market, the context of the market. And, concentration has been something that we've been banging the drum on for a couple of years now. And, what's interesting is that it keeps kind of concentrating a little bit further each year. Now, if you look at the top 10 stocks as they are today, 9 out of 10 of them are tech companies, with Eli Lilly being the exclusion. And together, they all account for 38% of the entire S&P 500. And you can see relative to history what the top 10 stocks were at that point in time and also how much of the index they represented. When you look at just the concentration number over time, 38.2%, almost the all-time high, and twice as much as the top 10 stocks were in 1990, essentially. So it's certainly gotten to be an exacerbated condition. And even if you look at the top 5 stocks, it's even further concentrated. So really, a lot of the market, working somewhere between a quarter to a third of the whole market, is in these 5 companies here. So they certainly better have the theme correct in their investment pattern. One good point of reference, and we get this analogy a lot, is this like the dot-com bubble? Unfortunately, the news is no, it is not. In fact, it's nothing like the dot-com bubble. Back, if we just take the tech sector and we look at the dot-com peak, the price return then was 86% driven by multiple expansion, which is basically just more and more and more investor enthusiasm, a willingness to pay more for the next dollar of earnings than the next person did. And in kind of a never-ending cycle of kind of enthusiasm and greed, with only 13% of the price return coming from earnings increases. Well, if you look again at what's happening now, today, you're in fact getting almost 200% of price return that comes from earnings growth and actually PE contraction. So the market's actually getting cheaper while it's going higher, a phenomenon we talked about. So it really is nothing like the glory days of the dot-com bubble. And that's a good thing. Again, back to the good news for the fundamental investor. Now, if we look for places to diversify away from the concentration risk that we talked about and some of the thematic risks that we talked about before, where can you turn within the U.S.? Well, you can turn to mid-cap stocks, which did well. The mid-cap 400 index up 17%. The small-cap index up 23, almost 24% on the year. Again, notably different than past periods. In fact, we're in a period now where small caps are outperforming the large cap index on a relative basis. And that's the first time since the pandemic when that really happened. And back then it was more low quality stocks than it is today. And I think that there's room to run. We think that because of the difference in valuation and the room that the valuation has to close until it gets to average, it really does provide some opportunity for small and medium-sized companies to continue to close that gap. And that is an area of diversification that we can look to, especially in the United States. Now, outside the United States, the same situation's happening. It's been a year now where we've seen outperformance versus the U.S. Markets. In fact, last year, the international markets outperformed the U.S. markets by the widest margin since 1998. Basically, what you're looking at is the bars will show, the blue bars is when U.S. outperforms and by how much, and then the orange bars are when international outperforms and by how much. And it's a pretty long bar for international last year. This year will likely finish the same, but just not the same magnitude. But it'll be interestingly enough to have 2 consecutive years in a row if that in fact happens. Case in point, there are opportunities outside the U.S. And some of that, just like with SMID caps, extends because of valuation. The U.S. valuation is in dark blue. The other international markets are in the other colors. And effectively, you're looking at about a 30% valuation gap between the two in every major valuation category to international's favor. And that's not just valuation, but also related to earnings growth. So earnings growth is also looking good on a forward-looking basis. These numbers in the middle of the screen are the next 3 years of earnings growth numbers for every major international market, and they all look quite good. So not only is the starting valuation good, but the forward-looking earnings growth looks good as well. International markets certainly have some opportunity in front of them. And as we turn to fixed income, one of the other major asset classes, let's take a minute to analyze where are we as of today. So we broke a 40-year megatrend of declining interest rates that stem back to the last inflation crisis we went through. We broke out of this downtrend in 2022 when the Fed hiked interest rates, and we've been bouncing around since then. You don't just break this type of a trend without a lot of reverberations, and we will likely be going through volatile interest rates for quite some time, particularly if inflation continues its higher than average trajectory. And right now we are bouncing around this level on the 10-year Treasury between 4.5% to 5% for most of the year. Now, the Fed, the Federal Reserve that is, controls the short end of the curve. So where will the Fed take short-term interest rates? Well, with a new Fed governor at the helm, it's anybody's guess. He seems to be a bit of a wild card at present, but the market is pricing in additional hikes for the rest of 2026, not cuts, which was the consensus coming into the year. Very interesting flip of the switch, and interest rates are likely to drift higher or at least stay flat from this point, certainly, or I should say likely, not getting cut. Now, where do we assess the opportunity to be in fixed income? Well, a good place to start is what are yields look like where you would make your investment? What's the starting yield look like across these major categories? The long bar that you're looking at is the 15-year range for yields, and then the diamond is where we are today. You're getting pretty attractive yields to start in these major asset classes, particularly in asset classes like municipals where there are some tax benefits on top of that. So you have effectively a pretty nice diversified mix of fixed income to get into. The problem is with interest rate volatility, your price return is a big question mark. But the yields look pretty good to start versus history. And I mentioned municipals. This curve is pretty wide. And what you're looking at is the difference between interest rates on a tax-adjusted basis for municipals, AA rated, versus Treasury. So similar credit quality, and you're getting much more compensation for the municipal version relative to the Treasury. So an interesting dynamic for the right investor who can take advantage of that tax benefit. And because we're looking for places to diversify that aren't fixed income for the last few years, and because of macroeconomic factors at play like Venezuela or the war in Iran, or really tariffs causing a lot of border-to-border volatility, commodities are of interest to everyone, including our team and our clients. And commodities, while it's not a 40-year interest rate trajectory or a 40-year downtrend, this one was a 12-year downtrend, and it was broken a couple of years ago. And here we are with a bullish feature happening, which would imply further upside to the commodity index. It would be a downside for consumers and upside for investors. But ultimately, commodities can provide inflation protection and diversification benefits outside of just stocks or bonds. And we are seeing that in the data. And I think just in plain English, I think everyone can expect commodities to be a little bit more expensive tomorrow than they were today, just based on all factors at play in the world. So diversification is one big theme. If you were to come away from today's presentation with a takeaway, it's that the markets are doing well, being driven by a resilient economy with a strong consumer. There are some points to consider, like inflation. We have midterm elections coming up. The corporate earnings situation driven by the hyperscaler investment is a theme that is hard to overcome negatively, and it will likely drive continued success moving forward. If you have any questions on what you've seen, please let us know. Reach out to an advisor or any member of the team, and we will certainly answer any questions that you have. Thanks for watching. Thanks for listening. Until next time, enjoy the rest of your summer and have a great back half of the year. Thank you so much.